Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. I have been away for a while on some other projects, been about 3 weeks now since I put out my last report. A lot has been going on. The biggest in my mind being that Fitch downgraded U.S. debt, which is like basically having the credit bureaus say that we just dropped your FICO score from 800 to a 750. When that happens to the United States government, that's not a good thing, and especially not good for bonds, considering bonds are how the government issues debt. And basically, they're saying that you have a little bit less likelihood today that the US government is going to pay you back than you did previously. Well, how do you offset that little bit less of possibility of getting your money back? You do that by increasing the interest rate, which is your return on investment, which causes the bonds to go up, 10-year treasury to go up, and the mortgage-backed securities to follow. Also, today we received the Consumer Price Index report for the month of July, and it came in a little bit better than expected. CPI report shows inflation gauge rose by 3.2%, less than expected. Overall month over month reading was 0.2, and also the core reading was 0.2. So that is a good thing. So the month over month reading showed inflation coming down faster than what was expected. But because we were replacing a year over year number that was a negative number, meaning that inflation was a negative back in July of 2022, the year over year reading of both headline and core inflation on the consumer price index actually went up today. So it's a very mixed bag, and the market is taking it in two different ways. Hey, it's a good month over month reading, but the year over year reading shows inflation going higher. Again, people need to look further into this to understand that if the month over month reading is coming down and we had an anomaly of a month a year ago, we have to look further into the actual factors that make up this consumer price index basket of goods and what actually increased and what came down to really understand what is going on. So if you want to say, hey, is inflation coming down? You really have to look a little bit further down the chart here. This is very basic. US Consumer Price Index, and this is showing about a couple of years here. And here we were at the peak back in June of 2022 at 9% on headline Consumer Price Index. Look where we are. We are at 3.2% from 9 to 3.2. So anybody that doesn't think that inflation is coming down is just not really watching the reports. Now, here's what we have to watch out for. All right. And I've said this many times, but this is really my concern. So if inflation is a campfire, okay, so let's look at this as a campfire, okay? Our economy needs a campfire. We need inflation. And usually they say that that should be somewhere 1.5 to 2.5%. So we kind of land on maybe 2% consumer price index inflation keeps the economy healthy, okay? If a fire goes down too low, what happens? It dies. You need to keep a little bit of fuel on the fire to keep the fire going and to continue to have domestic growth. So understand, okay, that should probably make sense. Now, when inflation gets crazy, okay, so when the federal government, for whether you're for it or against it, comes in and dumps trillions with a T, trillions of dollars into the economy, that is like dumping gunpowder and gasoline at the same time on your campfire. Okay. So obviously, that campfire just goes insane and rages way above the level that they want to see it at, that to be comfortable with inflation. So the Federal Reserve gets in there. And first of all, they don't even show up to the party. Okay. They don't show up to the party until the fire is already raging. All right. So they don't pay attention close enough to say, hey, you've dumped too much gasoline on. You might want to dump a little bit less because it's going to make this fire too hot. Well, they don't do that. They show up when you call the fire department. So now the fire is already out of control. The Federal Reserve shows up. They look at it and they say, man, we got a problem. Inflation is out of control. Now, again, they said, nah, it's fine for a long time. It's just a little fire. It's fine. It's transitory. All of a sudden they show up and they go, oh man, this fire is really raging. Well, guess what they need to do? They need to go back to where the closest fire hydrant is. They need to unload their truck and they need to roll out a couple 100 feet of hose to get this hose going to start extinguishing or bringing this fire down. All right. So that's what they were doing through most of 2022, and they're still doing it here in 2023. As a matter of fact, not only are they now spraying water on the fire, but they've been increasing the water pressure even as much as just the last time that they met, raising the federal funds rate by another 0.25%. So now we have water coming out of the hose at one of the highest rates in the history of the United States. Okay. It is really flowing. We are going to get that fire down. Now, here is the concern. Okay. We're looking at the fire. They're behind the hose. Okay, so they see the water, but they don't see the fire. We're looking at the fire and we're seeing the fire is greatly coming down, 3.2% from 9. They're getting it under control. But this is what we don't want to happen, and this is what the Federal Reserve tends to do, is that they will keep the water going and going and going full bore until it gets to where the fire is where it's supposed to be, which is at 2% inflation rate. Now, at that point, they go, all right, cool. The fire's where it needs to be. And they will begin to shut the hose off. Okay. But remember, they have to relay to each other, make the decision to shut the hose off, go back and tell them to shut the hose off. But all through that time, water continues to flow at full steam. And what do you think is going to happen? By the time they shut the water off, the fire is dead. There is nothing left. And then they're going to slow down the water because again, they want to slowly slow and the fire is dead. The fire is out. And that's what we do not want to happen. We are at 3.2% consumer price index rating, and they are increasing the federal funds rate as of just a couple of weeks ago. I'm concerned. Now, overall, the market, the mortgage-backed security market and the bond market, what are they seeing? So let's jump into where we're at on the charts here. All right. So we are down 56 basis points on our mortgage-backed security. As you know, if you watch this show, you know that that is a very bad day in the home loan interest rate world. And the 10-year treasury is up 10. Why is that? Because while we had a low reading on the month over month, it was still a high reading or an increase to inflation on the year over year. And a lot of people are not paying enough attention to the actual components that make up the CPI report and seeing that, yes, it was up. It is a blip. We saw that last year it was a blip in July of 2022 that we had a irregularly low inflation reading that we are now replacing. Month over month is 0.2. 0.2 times 12 is 2.4%. It's a good reading, but right now we're not liking it. Now, I'll tell you in just a minute here what we expect for tomorrow. Right now, we're down 52 basis points. It is 3:11 p.m. Central Time. By the way, today is August the 10th, 2023. Just in case you want to know what day it is, I don't think I mentioned that in the beginning. Here is our chart here showing that we were having a pretty good run a while back. And over the last few weeks, while I've been handling some other business, unfortunately, the bond market has not been happy and taking a beating. We had a little bit of a blip up here in a couple of days because we had a good reading from the Bureau of Labor Statistics employment, which helped us out, but unfortunately taken all those gains back now because of the year over year reading being not what we would like to see it, even though it was expected to be about the numbers that it came in at. Maybe we're even a little bit better than was expected to come in at. 10-year treasury again is up 10 basis points. We're over that 4.0 reading, which we don't want to see. Not good either way. Let's take a quick look a little bit further back. How bad is this? Well, it's not as bad as interest rates really are showing, because you can see that back here in October 21st of 2022, about a year ago, we were in a much worse territory as far as the mortgage-backed securities than we are today. Now, at this time, if I remember correctly, we talked about that our interest rates on the Brent Bruce Daily touched on 7.25% for a moment and came back down. And I had been talking about, this was back before when I was expecting interest rates to be down in the 4s by July, which clearly other things have occurred that didn't allow that to happen. But back in October of 2022, we were seeing those numbers come in and inflation was hitting that, the interest rates were hitting that 7.25, but quickly bounced back under the 7s, and we stayed on a 6 handle on most of our 30-year fixed throughout the rest of the year, which is what we were paying attention to. So where are we right now? Let's jump over here to the Brent Bruce Daily scenario here. And this, again, this is the same scenario that we've been looking at for a year and a half now, which is our very well qualified 30-year fixed conventional 800 FICO score, 25% down. Now, before I jump over here, I do want to mention one more time. I'm going to go ahead and run this scenario. I want to mention one more time. If you are doing business in California or Tennessee, give us a call. Send your customer to us. We will handle it. We will give them the best interest rates that they can get their hands on. We will talk to them about why things are the way they are and maybe help them understand that it is a good time to buy right now. And this is how we can structure loan transactions that will work the best for you as we go into the future and interest rates begin to come down. So here we are. Right now, 11 Mortgage is leading the pack here at 7.375 with a credit of $922. These are numbers that we really had not even seen in 2022. So even though the mortgage-backed security market right now is in better shape than it was back then, we're having higher interest rates. I can tell you one other thing here that I want to mention, and this is going long because it's been a little while. I also want to tell you the mortgage bankers of the world. Okay, the mortgage bankers. So there are three types of places that you get your home loans: banks like Chase, B of A, Wells; mortgage bankers, which is what you mostly see out there, guaranteed rate, these kind of things that are out there that aren't true depository banks, okay? Quicken, right? Or there's brokers, and brokers that's what I do, okay? So these are people that work with banks, wholesale banks, to get lower interest rates, different fee structure, things like that. Okay, mortgage bankers, the middle, are having a very, very difficult time making money. All right, because it's been such a long stretch of difficult interest rates, and the competition has been fierce trying to get the business that is out there. Mortgage bankers are the same. Mortgage brokers are seeing the same thing. Wholesalers, competition has been fierce, but people are really struggling from a overall financial perspective. And I think that's why you're starting to see rates come up a little bit as well, is that they just cannot keep going on with the tiny, minuscule, or even negative margins that they have been for the past year. So we're at 7.375 right now. The 11 Mortgage is leading the pack. They've been at the top for quite a while here and there. We can see that for 1 point, you're at 6.875. So if you want to get into that 6 handle, you're paying about a point. Remember when we were talking about that 5.99 number all the time? We're at almost 400 basis points, 4%, to get to that 5.875% range. So again, it's come a long way. There was a time, if you recall, within the last 18 months that I said 5.875 with no points on the Brent Bruce Daily. Okay, that's how far we've come while inflation has been going down the whole time. But yet we seem to hear that the overall consumer is strong, that employment is strong. Well, let's also remember that no one's been making their student loan payments, and consumer debt is now at the highest ever in the history of the United States, which is over $1 trillion. So there's been $1 trillion now that is not money that anybody has. Okay, so I can go on and on and on with what's going on, but I want you to know that we do see inflation coming down. I do believe that we're going to start to see interest rates come down shortly as well. We will see if the Federal Reserve does go and increase the federal funds rate again, even though that we see the flames of the fire have come way down, and we need to pull back on the water, let things settle down. And when they want to have what's called a smooth landing, they better start slowing down real quick, because they're at a real dive right now into that tarmac. Let me know what your thoughts are. If you agree, have any other comments, make sure that you like, subscribe, and share, and I will talk to you again soon.